Hey traders, how many of you would like to have a guaranteed system for finding winning trades? Well, I would too. Unfortunately, there are no guarantees in the stock market, but I do have a replicatable system that I use, 10-step system, for picking my trades that I think can help you guys build a more consistent result. So let's get into it. Hey traders, how many of you would like to have a guaranteed system for finding winning trades? Well, I would too. Unfortunately, there are no guarantees in the stock market, but I do have a replicatable system that I use, 10-step system, for picking my trades that I think can help you guys build a more consistent result. So let's get into it. So I call this system a recipe for success or formulaic trading. Now I like that word recipe because I view it much like a cookie recipe, right? A cookie recipe is very detail oriented, and theoretically, even if you've never baked a batch of cookies in your life, if you are open-minded, if you can read, and if you can follow directions, that's the key, right? Not deviate from the directions. Theoretically, you should be able to bake a batch of cookies that is as good a tasting batch of cookies as a professional chef that's done it a million times. If you can follow the recipe, because theoretically both of you are doing the exact same steps in the exact same order. Where we get into trouble is where we have spent years baking cookies and we think that we know what we're doing and we don't need the recipe anymore, and we start to deviate and we start to change the ingredients a little bit, and then we get off track, right? So following a recipe is really critical, and I call it formulaic trading. Formulaic trading is just a fancy way of saying that we have a systematic formula that we apply into our trading over and over again. What we do is replicatable. And we use what are called Boolean command chains or rules-based trading systems. Boolean is a word that I didn't know for most of my life, and it may not be a word that you're familiar with either unless you're maybe a software engineer, but Boolean command chains are used quite often in software, and it basically is just a system that says, if this happens, then do this. When this happens, react like this. So it's if this happens, then do this, right? And so we have a system in place of if a stock does this, we react like this. If a stock does this, we react like this, okay? And we boil it down into 10 steps. So let's get into the 10 steps. Let's talk about them a little bit one by one. The first step that we use in our 10-step formula is analyzing the broad markets. You guys know the 80-20 rule. You've heard of that a million times. It applies so many places in life. It applies in trading as well. Probably 80% of the moves up or down in your individual stock that you're trading are attributable to the overall broad market. As I film this right now, we've just come through the month of January of 2022. Crazy month in the marketplace. We had several days where the NASDAQ was down 500 points in a day. If you own a tech stock, no matter how good that tech stock is, that baby is getting thrown out with the bathwater, right? If the NASDAQ is going to go down 500 points in a day. So we really care more about what the broad market is doing than what any individual stock it is that you choose to go trade. I could care a lot less about what ticker symbol you're trading and a lot more about what the broad market is doing. And of course, there are only 3 major trends in the marketplace. We don't want to complicate this. There's only 3 trends: bullish, bearish, and neutral. So we want to be able to discern, number one, what is the overall trend of the marketplace? And that's going to help us determine a lot how we trade, not necessarily what we trade, okay? Number 2, in analyzing the broad market trends, is we want to find support resistance areas. So there's a lot of ways to find these things. I'm going to show you a couple of examples here in just a second. Number 3 is we want to find buy-sell signals in the marketplace, and we use at least a minimum of 3 indicators to help us find those. So let's talk about these just a little bit here. Number 1 is finding the trend in the marketplace, looking at it on a chart and saying, hey, is this a bullish or is this a bearish indicator? And finding those trends. That's pretty straightforward, finding a market that's moving up, moving down, or moving sideways, depending on the time frame that you want to be able to trade around. Number 2 is finding support resistance areas. Now, finding support resistance areas is very, very dependent in terms of what indicators you want to use. It's very dependent on the time frame that you want to trade. A lot of the trades that we do in our live trading room, some of the more popular ones are the 0 DTE SPX trades that we do on every Monday, Wednesday, and Friday. We're basically day trading the S&P 500. And so we're looking for very short-term indicators. And one of the ones that we use every day on that short-term basis are pivot points, okay? This is what a pivot point chart looks like. This happens to be on DocuSign. And if you are not familiar with pivot points, if you don't understand how pivot points work, I'm going to give you an opportunity here at the end of this training to be able to connect with me. And I can sort of walk you through how I use pivot points and where we apply them and how we apply them. Okay, so pivot points are a good indicator of finding support resistance areas for short-term trading opportunities. And then using buy-sell signals. We like to use at least 3 indicators to give us a buy-sell signal on a stock. They're pretty straightforward with what a lot of people use from a technical analysis standpoint. We use the RSI, we use stochastics, and we use the MACD combined with the histogram. So it's something that you guys are probably familiar with. This is a chart right here of the SPX, and I've got some Bollinger Bands going on in here. These are the technical indicators that we would usually use on a chart. This is the setup that we would normally use. We deviate from this at times to try to find other indicators to help us, but this is our core default setup right here. This blue line, this red line right here, those are Bollinger Bands. Again, if you're not familiar with Bollinger Bands, we can connect at the end of this video. I'll walk you through how we use Bollinger Bands and what they represent. Candlestick charting is how we view our price movement of the underlying that we're trading. We use candlesticks. And then we generally use, you can see in this example right here, let me go back here. We use a couple of different moving averages. We'll use a 50-day moving average, we'll use a 100-day moving average, and we'll use a 200-day moving average. And then on top of that, again, we use our MACD, moving average convergence divergence line, overlaid on top of the histogram. We use RSI and we use stochastics as well. So that'll give you a pretty good idea of what we are using to find indicators to trade with. Now, there are a lot of technical indicators out there. There's over 200 different technical indicators that you can put on a chart, and a lot of them track the same thing. They're looking at price action, and they're looking at volume, and they're looking at direction. So a lot of these technical indicators, you don't need 200 of them. The mix, the matrix of technical indicators that I have found that gives me the best reading, that I like the best, I swipe it every day from investing.com. And I can show you a quick look at it right here of what it looks like. This is the setup that I like the best. Now, this is on the S&P 500. You can pick what time frame you want to put your analyses on. I usually use a daily chart period of time. And again, as we're doing this video right now, it is Saturday, February the 5th. We've just come through a horrible January of trading. And you can see that it gives us a couple of things. It gives us a whole ton of technical indicators. There's 12 different technical indicators in here. If you're not familiar with what each one of these does, again, I'll give you the opportunity to connect with me at the end of this training, and we can go through those with you individually. And then we do a dual overlay of moving averages, everything from a 5-day out to a 200-day moving average. We use simple and exponential moving averages. This also helps us give us pivot points to find those support resistance areas in the marketplace. So right now the market is still in a sell mode, and I love using that as a ability to set up our trades as we go forward in our trading. I do post a copy of those 12 technical indicators and with the dual overlay of the moving averages on top of the pivot point support resistance areas. I post that every single day in our live trading room, and that's kind of what we start the day off on. So number one, analyze the broad markets. We're more concerned with what the broad market is doing, more so than what individual ticker symbol you want to trade, because it really is strategy dependent. See, we can make money on anything in the marketplace if we're right directionally. Right? If we can apply the right strategy. So step one, analyze the broad markets, figure out where we're at in terms of how those are trading right now. Step two is we want to analyze a heat map. Now, if you count ETFs, there's over 14,000 underlyings trading in the stock market, the US stock market, on a daily basis. And that's just crazy to think about. It's mind-boggling to think about that every day you wake up as a trader, you've got to search through 14,000 different underlines to figure out where those hidden gems are and how to trade those. Well, there's an easier way to find that visually, and I really, really like it. It is sort of a shortcut, if you will, to finding out where the action is in the marketplace and what that action is. Is it bullish or bearish action? Right? And that's a heat map. Now, I use several different software programs. I spend about $8,000 a year, $9,000 a year or so on software subscription fees. And one of the things I want to do in this training is, if you are not in a position where you are a consistently profitable trader yet, or you just simply don't want to spend $9,000 a year on software, I'm going to show you some shortcuts to that where you can find almost all of the information that I'm showing you here in a free format, okay? And one of the places that you can find a free heat map is FinViz. So if we go to FinViz, it'll kind of pull this up for us here. And again, there's over 14,000 underlyings trading in the marketplace on a daily basis. We are on a free site here, so let's see if we can get rid of some of the ads that are popping up here. But of the over 14,000 things that are trading on a daily basis, all of them fall into one of maybe 12 categories, what are called sectors, market sectors. We've got the technology sector, communication services, consumer cyclicals. Here's healthcare. Here's consumer defensive, real estate, energy, utilities, basic materials. I mean, they're all in here. Okay, so everything that trades in the marketplace is in one of these sectors. Now, if we go back and let's move from a one-day performance to maybe a 1-month performance, and this will give us kind of a snapshot of what's happened in January of this year. Boy, you can really see at a very quick glance where the activity was in the marketplace in January and what that activity was, right? Semiconductors, the whole semiconductor area just absolutely got slaughtered in January, and the energy sector absolutely killed it. Okay, so in a very quick glance, you can look at 14,000 underlying stocks and you can very quickly see where the action is taking place and what that action is. Is it bullish or is it bearish? So that's a huge, huge head start on finding the ticker symbol to trade. Now, we can go one step even better than that. Rather than, again, waking up every day and thinking, oh my gosh, I've got to sort through 14,000 ticker symbols before I find the thing that I want to trade today, we can just simply use ETFs. Guys, I'm going to show you how all you really need ticker symbol-wise are 12 ticker symbols. And you'll never need another ticker symbol to ever trade any idea or segment in the marketplace, because these 12 ticker symbols will control or touch on every single sector in the marketplace, okay? So the example that I use of this Again, there are several places that you can go to find this, but I use stockcharts.com because it is Java enabled and it is interactive. Here are the sectors of the overall marketplace, right? We've got discretionary, consumer services, technology, industrials, metals, energy, staples, healthcare, utilities, financials, real estate. All 14,000 underlines in the stock market trade in one of those areas. And you can see very quickly here, well, what area has been performing the best? Well, consumer services has been the worst. And as we have just seen, energy has been the best. Now, what's interesting is, I think, a couple of things with regards to this. Number one, again, all of these sectors of the marketplace have a ticker symbol. There's an ETF right up here that you can use to trade each one of these individual areas. They're buyable. You can go long them. They are shortable. You could short them if you wanted. And they're optionable. You can write options on them if you want to cash flow them as well. And so that's one of the things that I love is that, again, with 12 ticker symbols, you should theoretically be able to trade any idea that you have. Oh my gosh, I think that energy is too far overextended. Energy is too high. It's getting ready to come down. I could short that, right? Whatever idea you want to hit, you can do it this way. And here's what's interesting about that. Let's say that you think that energy is in a position right now that you would want to short it. If you're going to do an underlying company, what are you going to short? What are you going to short? You're going to short Exxon. You're going to short Chevron. How do you pick, of all of the companies in the energy sector, how do you pick the one that is going to be the best to trade, right? It's a needle in a haystack. And if you hit it right, I'm going to tell you, if you hit it right, there's a lot of luck that's involved in that, right? Rather than trying to pick the needle in the haystack and find that one company that is going to be your best opportunity, how about you short the whole entire sector or buy the whole entire sector? And you can do that right here with the ticker symbols that we've given you right up here above, right? Now, here's what's interesting. This is why I call it whack-a-mole. You've heard reversion to the mean when things revert back to where they are. Energy for the last year here is up 42%, right? Folks, oil, ExxonMobil, these companies don't grow by 42% a year, year after year after year. No company does, really, for an extended period of time. Not even Tesla, right? Things ebb and flow. And so if you come down here and you change the time frame that you are looking at these, you can see this ebb and flow right here, right? So at this point in time, you might say, oh my goodness, look at this. Technology is killing it right now, and energy is absolutely just sucking wind right now. Reversion to the mean, maybe I might want to put on a pairs trade where I'm looking to short the energy sector and short the technology sector, go long the energy sector, right? So we put those trades on, we go forward a little bit in time, and boom, look what happens. That revision to the mean takes place, right? We can go back in time as well here. You can, again, look at things that are, what's the second worst performer here to energy? Well, that would be the financials, right? Financials are the second worst performing here in this section. So you say, well, yeah, banks, are they doing well or are they doing poor right now? Well, they're paying zero interest on their deposits and they're lending at high. Their margins are huge right now, right? Maybe this is temporary reversion to the mean. Maybe I should start buying some financial now because they've been underperforming in the hopes that they get that reversion to the mean. And so we watch some time go by and there you go. Right? So again, there's always something to trade. What's interesting about trading ETFs, these particular 12 ETFs, is that no matter what the market's doing, whether the market's up, down, or sideways, there's always a trade in there. There's always a trade. You're always going to be, no matter what the market's doing, you're always going to be able to look at this and say, hey, there's something that's overextended to the upside. I can short it. Or there's something that's overextended to the downside. I want to start nibbling on that and start buying that, right? So that would be using heat maps. That would be using ETFs to trade. So now we've got you down to just 12 ticker symbols that you need to be able to trade with. We've got you a way to very quickly visually find where the action is in the marketplace. But we still need to do a little bit of research, right? So step 3 of trading in a formulaic approach, a 10-step approach to trading like a business, treating this as a business, is to utilize software analytics. And I love this. Now I do, again, I spend $8,000 or $9,000 a year on several different software programs. I love them. I find tremendous value in them. For me, with my portfolio size, one good trade can pay for my software for an entire year. So it absolutely makes sense for me. There are free versions of a lot of what I'm showing you here. Once again, kind of have to piecemeal them together. There's not one place that you can go that will do all of the stuff that I'm showing you here. But if you don't want to buy software, you don't have to. And again, at the end of this training, I can give you a link to contact me. I can walk you through some free options. But use software. Number one, run backtesting analyses, right? I use Tastyworks. I use Tastyworks as a broker. And in fact, if you want to use my referral link to open a Tastyworks account, I will send you a $50 Amazon card. So I'll put a link in the description here at the end as well for a referral link to open a Tastyworks account. But I digress from that. Even Tastyworks right now has the ability to run backtesting software. You should have access to some system, such as a Monte Carlo modeling system, that can take any strategy that you want to employ and go back and randomize it over 100 or 1,000 different trades historically and look at how that trade would work out. It's crazy to me that people will throw on trading strategies with a pretty decent amount of their own capital at risk, and they don't know what to expect with that trade. They've never done it before. They don't have any basis to understand the risk-reward ratio of that trade. Backtesting software can help you with that. Okay, so if you're not using a broker like Tastyworks, first of all, I'd recommend that you do check them out. I use them. I've saved over $12,000 a year in commissions by changing to them because of their commission structure, so I believe in them. Number 2, run filters and screens for trading. Look for opportunities and work fundamental pricing models. So filters and screens and pricing models. Let me talk about this for just a second. And I'm going to go into one of the software tools that I use. Now, this is a little bit biased here because this is a software program that I did actually have a hand in developing. I wasn't the software engineer or a developer on this program, but I was in the beta system for this software, and I was on the team that would make recommendations as to what we wanted to see and how we wanted to see it. So I'm a little bit biased in this software. It doesn't need to be this software. There's so many places that you can go and do this, but sorting and searching through the 14,000 stocks that are out there, there are so many things out there, and it's so hard to find what you're looking for. And so I find that it's nice to reverse engineer rather than looking at a ticker symbol and saying, is this tradable? And then no. Okay, I'm going to pull up, let's look at Amazon. No. Let's look at IBM. No. Let's look at Google. Rather than going from that standpoint, let's reverse engineer it and let's come up with a strategy or an idea first. And then we'll find the ticker symbols that meet that criteria, right? So there's a lot of strategies and there's a lot of scans that you can do in here. I'm not going to take you through all of the scans here, but some of the ones that I like is stocks that have increasing operating cash flow, stocks that are good for covered call situations. If we look at outlooks, for example, we can look for stocks in today's market. I would look for bear market strategy stocks, right? How many stocks have a death cross going on right now? There's 14,000 stocks underlying that you can trade in the U.S. stock markets right now, and you've only got 3. There's only 3 stocks right now that are in a death cross pattern, right? So how much work would you have to put in manually if you wanted to find those stocks, right? Stocks with bearish descending triangles. There's 14 stocks that meet that criteria right now. Boom, there they are. Okay, there's all kinds of different. How about volatility trades? How about stocks that have upcoming earnings with a move that is potentially bigger than expected in the next week? There's 33 of them right there. You got 33 opportunities to trade volatility next week if that's what you're looking for. You can trade via strategies. What if you say, listen, I really like iron condors. Those are my favorite trades, are iron condors, right? Well, there's some iron condor candidates right there for you that you could go pull up. Now, there's 14,000 stocks, again, trading in the U.S. stock exchanges. Does that mean that these are the only ones right here that you can do an iron condor on? Well, not necessarily, but they're the ones that meet the best criteria. How long would it take you to find those individually, right? Now, a couple of other things that we talked about here. I did talk about, let's go to research. Let's look at a stock. And let's go to maybe valuation tools here. This is what I was talking about fundamentally modeling a company, right? Now, this is Chewy, CHWY. This is all the information on it right now. This is the valuation methods that we look at a stock. PE ratios, price to cash flow ratios, price to sales ratios, the alpha and the beta of the trade, the price to book ratio. And we can change a lot of those numbers. We could do a modeling effect on this stock if you wanted to. We could say, well, what would happen? You know, the price right now of Chewy is about $49 a share. You can see that right there. What would happen to this stock if the earnings per share grew? Right? And you can see that simulated projection on the price and how that would change. What happens if the growth rate of the earnings of this company were to change? What if they were able to accelerate or maybe even decelerate in their earnings growth? What if their PE ratio expanded or contracted? What would that do? How does the PE ratio look historically for Chewy? And what if it reverts to the mean? What would that mean for the stock price, right? So we can work on all kinds of projections here. But again, you don't necessarily have to have this particular software. In fact, you don't need to necessarily have any software, but you need something to be able to search and sort through the marketplace of 14,000 underlines to find maybe 20. And that's where I usually start. I'll come up with an idea. Hey, I want to do a bearish trade today. We're going to start with 14,000 names. We're going to whittle it down to 20. And then I'm going to refine that search one more time, whittle it down to maybe 5 or 6. And then I will take the time to go through all 5 or 6 of those individually and try to find the one that best suits my needs. Now, there's a couple of other aspects to software that can help you with trading. And again, it comes down to what time frame you are looking to trade. These pieces of software that I'm going to reference right now are particularly attuned for day traders. Okay, technical analysis is in essence a culmination of historical data. And so because of that, it's not necessarily a leading indicator, it's a lagging indicator, right? You're using historical data to predict future movements. And so technical analysis in general doesn't work that well for day trading. It doesn't work that well for zero DTE, SPX strategies. And so you need to use something else. And the thing that I look at the most when we are looking at day trading is footprint charts. Okay, footprint charts are maybe a little bit different than what you're normally used to seeing. We generally use candlestick charts here. We love candlestick charts because they give us 4 data points every single day for a stock. You know, if I ask you, hey, where's Coca-Cola at? What's Coca-Cola doing? And you say, well, you know, it's $22 a share. That's meaningless to me, right? That doesn't mean anything to me. There's no relevance or control study to balance that off. But if I say, well, I'm going to give you 4 data points every day for a stock. This is the price that it opened at this morning. This is the price that it closed at this evening. This is the price that it went to on the downside. This is as low as it went. And this is as high as it went during the day, right? 4 data points. Now I can start to develop pattern recognition. And that's what candlesticks give us, is that ability to pull 4 prices on a stock every single day. High of the day, low of the day, opening price, closing price, right? So candlesticks are great for that. We use candlesticks predominantly in our trading. But when we're day trading, I love footprint charts here. Footprint charts are the same thing. Let's just take this one right here. You can see that red bar right there. That means that the stock is down from its previous tick here, and these are all the bid prices of orders coming in. These are all the ask prices of orders coming in. These are buys, these are sells. And you can see where the activity is centered. You can see where the activity is directed. Is it coming down? Is it coming up? And you can actually see the price action that's going on in the marketplace. So when people say, hey, we're day trading, what technical indicators do you look at? I don't look at any of that. I look at price action. Price action and order flow. We call it price action or order flow. But if you are not familiar with tracking order flow, if you're not familiar with tracking price action and understanding, are there more buyers than sellers, or are there more sellers than buyers, and what's the ratio, and how big is the ratio, right? It's not just about, hey, there's a lot more sellers than buyers here. It's about how big of volume are we seeing there? How big of a confirmation is that, right? So if you're not familiar with order flow or price action reading and using footprint charts, I am starting to work on, very slowly, but I am starting to work on a training program to understand order flow and price action. And if you would like to have access to that for free, I was going to put a training together. I was going to try to charge something for it. I think I'm just going to do it for free. So if you're interested in that, if you would like to get access to that when it's done, please email me here at chiefchangecatalyst@gmail.com and put order flow in the subject line. And I'm going to put you guys all on a waiting list. And when I get it done, I will give you access to the training for free. Okay, so that's order flow right there. That's important. It's a little different than what you're usually used to, which a lot of times is candlestick charting. Now, the other thing that I use on short-term trading as well, day trading specifically, is Tickstrike. Tickstrike is awesome. And if you just go to YouTube and you type in the word Tickstrike, you'll find a lot of videos on them. You can just go to tickstrike.com. That's their website. And that's probably the easiest place to go, is tickstrike.com. But what Tickstrike does is it takes that order flow that I just showed you, takes that footprint chart and all of the buy orders coming in and all the sell orders coming in, and it turns it into an audible feed. So it's almost like a Geiger counter, and you can hear the tone and the tonality and the pitch and the rapidity of that tone change. And that will give you an indication as to whether we're in a buy mode or a sell mode, and whether that buy mode or sell mode is advancing and increasing or decreasing. So everybody's a little different. Some people are kinesthetic. Some people are very visual. Some people are very attuned to sounds. And I love both. I love watching the footprint chart and seeing the orders come in and out, and I like listening to it simultaneously. So I use Tickstrike. I am a contributing editor to financialjuice.com, which is the originator of Tickstrike. And so if you check out Tickstrike, if you go to tickstrike.com and you like that, you see value in that, again, email me at chiefchangecatalyst.com at gmail.com and put discount Tickstrike in the subject line. I can get you a discounted price. So don't pay full retail for Tickstrike if you're interested in it. But I love it, and I can get you a discounted price on that. Okay, so that's Tickstrike. Love that. Now, let's talk about that Boolean chain command. If this happens, then do this. If this happens, then do this. If this happens, then do this, right? So we're going to start out, we're going to choose an underlying trade. We're going to figure out what we're going to trade. We want to choose time frames. Time frames are sometimes more important than what you're trading underlying wise. If you don't know how to figure out what the right time frame for a specific strategy is, again, I'll give you an opportunity here at the end of this video to touch base with me, and we can talk about the differences in time frames. Each one has a pro and a con, right? But we're going to choose what we're going to trade. We're going to choose how long we're going to trade it. And then we start looking at things, right? Is there an earnings announcement? Let's say that we're going to trade it. We're going to build a trade for a 30-day window. Is there an earnings announcement that's coming out in that time frame? Is there a Fed announcement coming out? Is there a dividend payment due during that time frame? Is there any other corporate news that might be coming out during that time frame? Is this a biotech stock that we're trading and they may have a phase 3 clinical trial pending in front of the FDA? You know, we need to know all of those things, right? And if the answer to any of these is yes, one of those things is going to be happening during our holding period, then we should probably consider waiting or choosing another underlying to go trade. We want to control as many variables in our trade as we can, right? And we don't want uncontrollable variables changing the outcome of our trade. So if the answer is no, then the next question is, well, are you bullish, bearish, or neutral? We've talked about how to decipher which direction you think that's going. Are you bullish, bearish, or neutral? If you're bullish, there are several trades that we could go do. Depends on if you're extremely bullish, moderately bullish, or slightly bullish. If you are neutral, there are several trades that we could do. Depends if you're extremely neutral, moderately neutral, or slightly neutral. If you are very bearish, there's a bunch of trades we can do as well. There's basically 6 core options strategies that you can use for any market direction, up, down, or sideways. So there's about 18 core strategies that you can use at any given time. And then when we start adding ratio trades and complex trades into that, where you vary those 6 strategies, core strategies, there's almost endless amounts of option strategies that we can use. But you have to figure out which one are you going to use, which approach are you going to start with, right? Step 4 is we want to select a trading strategy. So we're going to pick from those core strategies. We're going to figure out if we're going to be trading bullish, bearish, or neutral. We're going to figure out if we want to do a credit trade or a debit trade. This is a whole other conversation, figuring out credit trades versus debit trades. I like both. I am predominantly a credit trader. There are pros and cons to each way, right? Risk-reward ratio is much safer with a debit trade. Probabilities of success, much lower. Credit trades, you can build a credit trade that has a 90% probability of success, 95% probability of success. We just built a nat gas trade inside of our live trading room here last week that had a 98.5% probability of success. But you have a poor risk-reward ratio, right? You're putting up a lot of money for the income that you could potentially make. So each one has a pro and a con. Again, if you don't understand the difference with those, you can touch base with me at the end of this and we can chat about that. Okay, number 5, structure the trade. So we need to work on our entry price and we need to work on the method that we get into the trade with. Now, market orders and limit orders. We use limit orders to enter our trades. We use market orders to exit our trades. You want to know specifically what you're paying for something when you get into a trade. We make our money on the entrances to the trades, not the exits of our trades. And so we use limit orders to get in. We try to scale into our trade. So if I have $10,000 that I want to put into one trade, I'm going to break that up into 1/3, 1/3, 1/3. I'm probably going to start with about $3,300 of my $10,000 initially. I had one of my mentors years ago say, and I've always remembered this, Scott, how arrogant are you? How prideful and arrogant are you that you would find a trade to make and you would take 100% of the money that you've allocated for that trade and dump it all in at one time? Because what does that imply? Well, it implies that you feel like you have figured out what the absolute bottom best price is, right? And of course, even if you do, it's very lucky that you hit that. So we never know if we're going to get in at the best price, whether it's shorting or buying. And so we want to scale into those trades, right? Stop losses or risk management comes next. We love the phrase, and we use this mantra all the time in our live trading room. We hope for the best. We expect the worst. We hope for the best. We always expect the worst, right? You build your trade, you look at what the profit potential is, you're all excited about that. You immediately change your mindset to what is the worst thing that could happen to this trade? And then you figure out how you're going to manage that, right? You figure out how you're going to manage that. You manage that risk-reward ratio. Most trades, if you're buying or shorting something, it's going to be a 1-to-1 risk-reward ratio, right? We want to try to get that a little bit higher than that. We want to have an edge in the marketplace. The edge doesn't have to be huge, but it needs to be there. We need to have some type of an edge to where our profit potential is greater than what we're risking, okay? Part of doing that is developing a profit target. It's amazing to me how many people, how many traders I talk to, and they say, oh, I've got an amazing trade. It's an ABC stock. I think it's going to be amazing. It's going to make me a bunch of money. And I say, how much? And a lot of times they'll say, well, I mean, honestly, I have no idea. I mean, who knows where this is going to go to, right? Well, if you don't have a profit target, it may not be right, but if you don't have one, if you don't have a profit target of where you're going to exit that trade and where you're going to get out profit-wise, how do you know if it's a good trade or not? I mean, does it have a 1% profit target? Does it have a 100% profit target, right? You need to know that. The other one that is equally as important is the time frame of the trade. And this is one of the reasons why I do like credit trades. I can tell you to the minute when I will be done with a credit trade because those options expire, right? And we know when they expire. So you would never want to just get into a trade that you don't know what the profit target is and you don't know when the exit time frame is, right? I try to trade in a way that I can use money from my trading to supplement my lifestyle, feed my family. I can't go to my bills. I can't go to my mortgage company and say, listen, I got some really good trades working right now. I have no idea when they're going to come to fruition, but boy, when they do, I'll make sure and pay my bills, right? So you need to have a time frame in mind of when you're going to exit those trades. Credit trades are very, very helpful in that regard. Step 6 is negotiate with the market makers. Work that bid, ask, ask spread using limit orders. We use limit orders to get into our trades. We use market orders to get out of our trades. And working that bid, ask, ask spread. There's 3 prices. If you're not familiar with this, if you're new to trading, there's actually 3 prices on everything. If we're trading ABC stock, you might see a bid price, right? Maybe $10.25. You might see a ask price of $10.55, and you might see a last price of $10.37, for example, right? What does all that mean? Well, bid is wholesale, ask is retail, last is the last price traded on the stock exchange. So generally speaking, if you want to buy something, you're going to pay the retail price, you're going to pay ask. If you want to sell something, you're going to receive the wholesale price, you're going to see bid. But market makers will negotiate with you. So many traders just push the market button and they just take whatever they get. When they sell, they're going to get the bid. When they buy, they're going to pay the ask. But the last price you can see traded was $10.37. So you can work that bid-ask spread and you know that there's some room for negotiation there. Some of our day trades that we do every Monday, Wednesday, and Friday in our live trading room on the NASDAQ and the Russell index. Not so much the SPX, but the NASDAQ and the Russell. They've got wider spreads and they're harder to get fills on. Sometimes we will work that trade 5, 6, 7 times before we get an execution price that we like. So make sure that you negotiate with the market makers. Don't pay retail when you're buying. Don't accept wholesale when you're selling. Okay. Step number 7 is trade repair. If you think that every one of your trades that you ever make is going to be a successful trade, you are in for a big surprise. We have to adjust a lot of our trades in our live trading room. And so you need to be able to adjust those. Now, I've got a whole entire YouTube video up on the YouTube channel on just adjusting trades. It's 30 minutes long. And I will put a link below in the chat room here, or excuse me, in the comment section for that video so that you can watch all of those as if you've not seen the way that we adjust trades. But essentially, all of our adjustments work several ways. We're looking primarily for what we call the trifecta, which is rolling out to gain more time in the trade. For whatever reason, the trade just didn't work in our specified time frame. We still like the trade. We just ran out of time. So we're going to roll the trade out to gain more time in the trade. We might defend the trade by adding some insurance protection in there, hedging the trade. We're big on hedging the trades. Or you could even use something like what we call the supercharge approach, which allows you to reduce your break-even points, right? And I'll give you an example quickly of the supercharge repair strategy. Let's say that we bought 100 shares of stock at $50 a share, and now it's fallen down to $40 a share, right? We're down $10 on the share. We could go out in the options market and and again, this is just an example, but we could go buy one 60-day 40 strike price call option for $3. Gives us the right to make money if the stock goes up above 40, which is where it's currently priced at. And we could simultaneously sell 2 of the 60-day 45 strike price calls for $1.50. Now, this is a cost-free trade. This trade doesn't cost us any money because we're going to spend $3. We're going to bring in $3. It does not cost us any money, but if it works, it reduces our break-even point and it reduces our cost basis on the trade from 50 to 45. And every 60 days, we could do this over and over again, right? So again, if you're not familiar with repair strategies, click the link in the description and we can talk about that a little bit. We also want to scale in and out of our trades. Again, it's incredibly prideful. It's incredibly arrogant on our parts to think that we're going to be able to short something at exactly the height, the top of the market, or buy something at exactly the bottom of the market. And so we like to scale in and out of our trades. If we bought something down here, for example, at $6 and it goes up to $8, it's probably a prudent time to start taking some profits, right? I'd sell 50% of the position. If it goes up to $10, maybe I would sell the other 50%, right? So we scale into trades We also scale out of trades. Okay. Step 9 is we want to apply the macroeconomic principle called the velocity of money. Banks have mastered this concept. They've mastered this principle, the velocity of money. The velocity of money just simply says that money needs to stay in motion to make money. And the more the motion and the faster the motion, the more money is made. Think about a bank very quickly. You take your $1,000 in, put it in your checking account, and you come back tomorrow and say, I'd like my $1,000 back. They don't go back into the vault and go to the little slot with an envelope with your name on it with your $1,000 and say, here's Scott's $1,000, and bring it back out to you, right? With fractional share banking, at least in the United States, that $1,000 that you put in your checking account yesterday is already gone. It's already out the front door of the bank in the form of a cash advance on a credit card, a home equity line of credit, a car loan, something along those lines, right? Banks know that they can't sit on cash, that they need that money to work for them. And the more they can flip that money, the more they can turn that money, the more fees they can generate off of that money, the more money they make, right? Money in motion needs to stay in motion to make more money. So we want to apply this to trading as well, this macroeconomic principle, and we want to close trades once they hit what they call the efficiency frontier. Now, what is the efficiency frontier? Well, let's jump into one of my accounts right now, and let's see if we can find a trade to look at that might be a good example. So here's one of my accounts right here, and I think I found an example that will give you an idea of what the efficiency frontier is and why it helps us maximize our returns, right? I'm going to go to one of my trades that this is a nat gas trade that we put in right here. This is natural gas. This is a futures contract, but we put it on, you can see there's 18 days to go in this trade right now. We put this trade on just a couple of days ago, okay? This is just a couple of day old trade, and you can see that I put up about $792. That was my investment into the trade. It was a credit trade, and I sold options worth $210. So that's enticing. You know, that's an interesting trade, right? That type of return, that's like a 20-25% potential rate of return in a 3-week trade. That's awesome. I love that. It has a 97% probability of success. If you can build a trade that has a 97% chance of working that can make you 20-25% return in 3 weeks, I mean, that's wonderful, right? And so you just get kind of lulled into complacency with this trade. You're like, well, you know, it's working, it's making money, it's got a really high probability of success. But the reality is I should probably close this trade out, get my $792 back, and go do something different with it, right? Because we're just a couple of days into this trade. There's $124 of profit sitting there in the trade right now. There's only $85 of extrinsic value or potential additional profit sitting in the trade. And I'm going to have to wait 18 days to get that. I'm 2 days into the trade. I can make almost a 14%, 13% return in 2 days. I should take that. And I should get that money back. And I should go find another opportunity similar to this, right? I don't want to be complacent with my money. The only asset you have as a trader is your capital. And you want your money to work as hard for you as you worked for it, right? So make sure that you're not just sitting complacently in trades that are very, very profitable, so you feel very good about them, but there's not a lot of profit potential left in them, right? Maybe you should close those out, get your capital back, go find another opportunity to redeploy that money into. Excuse me, step 10, last but not least, we want to record all of our trades in our trading journal. We should all have a trading journal. One of my favorite phrases of all time is that progress cannot be made unless actions are first measured. A lot of traders I talk to, I say, you know, what's going on? Well, I'm not having that much success with my trading. Why? And if they're honest, the answer is more times than not is, you know, I honestly don't know. If I did know, you and I wouldn't be talking right now, right? And that's fair. But again, guys, we have to record what we're doing. Progress cannot be made unless actions are first measured. So we have to record all of our trades in a trading journal. Now, again, I have a trading journal that I love, that I have used for 15 years. I think it is the best trading journal out there. And I do have a discount code for you guys if you're interested in buying it. And so I'm going to put a link in the description box below for that as well. I've also got a YouTube video that you can watch on that I'll talk about in just a second. So we want to record everything that we do. We want to document everything that we do. And then we want to apply sensory acuity to our trades. Sensory acuity is just a real fancy way of saying 20/20 hindsight. It's a way to simply look at our trades in retrospect and analyze them. And what we want to analyze is our losing trades. I don't pay any attention to my winning trades. I don't even look at them a second time, because there's not a lot that can be learned or gleaned from looking at your winning trades other than a nice pat on your back and say, good job, do it again, right? It's the trades that don't work that we want to analyze and say, okay, why didn't they work? Is it just the way the cookie crumbled? We know all of our trades aren't going to work. Is it just the way that the cookie crumbles and the way that things kind of shake out in the marketplace? Or did I breach some rules? Did I do something wrong in this trade that I probably shouldn't have done? And I will tell you, I've done this for a long time. I started on Wall Street in 1987, so I've been at this for a few decades. I still find myself making mistakes where I'm like, no, that was me. That was my bad. That was on me. The reason that trade worked was because I messed up, or didn't work was because I messed up, right? So we want to analyze our trades. And then last but not least, we need to review our results with an accountability coach. I am a huge, huge believer in this. I race dirt bikes. I love dirt bikes. It's my passion. I'm old. I'm 55. You need to be in good shape to do that. I'm never in the shape that I need or want to be in, but I want to be in really tip-top shape, right? So I hired a trainer at a gym once, and I remember him saying, I didn't show up for a training session once, and he called me. He said, "Where are you?" I just said, "I don't have the time to do this." And he said, "That's a lie." I said, "Excuse me?" He said, "Well, I'm at the gym right now, and there's people here. And the last time I checked, they have the same 24 hours in their day as you have, right? So when you say you don't have the time, that's a lie. What you really want to just say is that this is not a priority for you, right? And if this is not a priority for you, you are no longer a priority for me." And he hung up on me. And I've always remembered that, right? So it's important to have an accountability coach. It's important to have somebody that you can talk to at the first of the month, set out goals, look at your portfolio, look at the trades that you're doing, look at the style that you trade, set an expectation, and then revisit that conversation 30 days later at the end of the month and have them be as objective as they can and go through your trades and say, okay, here was a mistake, here was a mistake, here was a mistake, right? So if you are interested in having an accountability coach, that's something that we can talk about, certainly, but it's important to have, right? Trading journals. I do have a link to a trading journal here that I love. I think it's the best one out there. I do have a 17-minute review of it and how it works on how to track and improve your performance by using trading journals. So again, I'm going to put a link in the description box below for that to help you guys with that. Okay. And then finally, last but not least, guys, I love this saying from Benjamin Graham. He basically says, listen, people don't need extraordinary insight or intelligence. What they need most is the character to adopt simple rules and stick to them. Now, of course, Benjamin Graham was the mentor of a little known investor back in the day called Warren Buffett, right? And I love that. People don't need extraordinary insight or intelligence. What they need most is the character to adopt simple rules and stick to them. Just follow straightforward rules, and we can give ourselves an edge, an advantage. There's no guarantees in the marketplace, but we can certainly give us an edge or an advantage if we follow certain rules, right? So one of the things that I want to do, and we'll see how this goes, but I want to offer you guys a free one-on-one consultation with me where we can spend 30 minutes together on a Zoom session and chat about what you have going on in your trading world and how that is working for you. And I am going to endeavor to give you at least one tip, one idea, one strategy that can hopefully help you improve your situation. There's no cost to this. In all likelihood, I am probably going to try to give you a link to sign up to one of my 2 different trading systems that we have out there. But I'll give you a free trial. You can try it at no cost. And even if you don't want to, that's fine as well. I would like to connect with you, and I would like to chat with you a little bit, see what you're doing. I always love to check in on the trading community and find what other people are looking at in the marketplace, how they're trading that. And so I think it would be a beneficial 30 minutes for each of us to spend. If that's something that you want to do, if you want to just chat a little bit about your trading, you just want to bounce some ideas off of somebody, you want to have a 30-minute accountability session, Man, let's do it. You can use this link down here below, calendly.com/theta seller. If you go there and you click on that link, it will take you to a website where you can go and you can schedule a free one-on-one Zoom session with me. I do have Tuesdays and Thursdays right now blocked out for those. And I would love to have the ability to chat with you guys just a little bit. So thank you guys. Hope that all helps you. And we'll see you on the other side. Good luck to your trading.